everyone, welcome to EduTap and welcome to today's session. So the Reserve Bank of India has released the notifications regarding the revised regulatory framework for the urban cooperative banks. So these three are the notifications that has been released by the RBI on 1st December 2022. Okay, so the notifications are regarding the revised framework, the revised regulatory framework of the urban cooperative banks, and the revised regulatory framework includes the categorization of urban cooperative banks. So the categorization has happened in 4 tiers for the urban cooperative banks. Okay, as well as the review of norms, the norms that were there for the financially sound and well managed UCBs, that has been revised, that has been reviewed. So regarding that also there is a notification. Then the third notification was regarding the net worth and the capital adequacy, the revised norms, the revised regulations for the net worth and the capital adequacy of the UCBs. So we have already discussed about the categorization of UCBs. We have already discussed about the financially sound and well managed UCB. Today we will be discussing about the net worth and the capital adequacy of the UCBs. Okay, so this is going to be a really important session for you to revise these two. So today we will be revising these two notifications and we will be understanding the third notification. Okay, but before starting with this important session, you must know all the revised regulatory framework for the UCBs, because direct questions can come from such notifications. Okay, as well as there is much data that has been provided, there is much percentages that has been provided that you all must know, as well as the net worth and the CRAR, they are very important for you to remember. Okay, so now before starting with this very important session, there is a big announcement from EduTap that we have brought for you the comprehensive guide for RBI, NABARD and SEBI. So through a single guidebook, you can get all the answers of your common queries. If you want to know about the examination, that what is the pattern of the exam, what are the previous year cutoff of the exam, what is the syllabus for the exam, all of these queries can be answered through a single guidebook. You do not have to visit different links, you do not have to visit different websites. Okay, as well as if you want to know about the preparation for the exam, that what should be the sources for the preparation, what should be the strategy for the preparation, all these common queries can be answered through a single guidebook, and your efforts, your time can be saved through this single guidebook, which provides you all the answers to your common queries for the examination, so that this is going to upgrade your level of understanding for the examination, and you do not have to find the answers in different areas, in different links and websites. Okay, so do download this free guidebook that is available easily, and the link is given in the description box below. Okay, so now starting with today's topic, that is, this is the revision for the first notification that was regarding the categorization. So the categorization has happened in the 4 layers, in the 4 tiers. Okay, so the UCBs are now divided in 4 tiers. Before they were divided in only 2-tiered framework. Okay, so before it was 2-tiered framework, and now there is 4-tiered framework, and it has been applicable. The 4-tier framework has been applicable with immediate effect, means from 1 December 2022. Okay, and this is applicable to all the primary urban cooperative banks. So you must understand, I have already discussed with you that what are these 4 tiers, and these 4 tiers are as per the deposit size. They are as per the deposit size. So you must remember that the tier 1 is from what to what, the tier 2 is from what to what. Okay, so the next notification was regarding the financially sound and well managed. So there are some criteria, certain parameters according to which the UCBs are considered as the financially sound and well managed, and these are the criteria that the UCB, like the tier 2 UCB, that has to manage 12% of the CRAR. Okay, so the CRAR shall be at least 1% above this 12% to become the FSWM with other criteria. So such kind of criteria are there. This also we have discussed in the previous session. Okay, so you must know all these criteria. Any question can come, like the statement based question can come, or the direct percentage can be asked. Okay, and what will the UCBs will get after becoming the financially sound and well managed? They can directly open new branches through the automatic route, and this is 10% of the branches, or new branches can be opened 10% of the number of branches that they already have in the previous financial year through the automatic route, through a easier route. And this revised instructions for the financially sound and well managed. So these are the revised criteria. These are the certain parameters now. So they have been applicable with immediate effect, that is from 1st December 2022. This circular is applicable to all the primary urban cooperative banks. So these two notifications, that is regarding the categorization and FSWM, we have already discussed in the previous session. Okay. So today let's start with the third very important notification, that is regarding the net worth and capital adequacy ratio, that is the CRAR. Okay. So starting with, see, the previous two circulars, the previous two notifications, they have been applicable with immediate effect. But this circular is applicable to all the primary urban cooperative banks. So this point is same, but this will be applicable. The instructions come into effect from 1st April 2023. So this is not from immediate effect. This is going to be applicable from 1st April 2023. Okay. So UCBs shall have minimum net worth of what? So starting with the net worth, how much net worth they should have. Okay. So the tier 1 UCBs that are operating in a single district, they shall have the minimum net worth of only rupees 2 crore, and other than these that are operating in the single district, the tier 1 that are operating in the single district, other than these, all the UCBs should have the minimum net worth of rupees 5 crore. That is the tier 1 UCBs that have more than one, they are established in more than one district. Those as well as all the other tiers, tier 2, tier 3, tier 4, they should have the minimum net worth of rupees 5 crore. Okay. So what you have to remember is tier 1 UCBs with, that are present in only in a single district, they are operating in only a single district, they should have the minimum net worth of rupees 2 crore. And if the tier 1 UCBs, they are operating in more than one district, and other tiers, that is 2, 3, 4, they have to maintain the minimum net worth of 5 crore. I hope that is fit in your mind now. Okay. So UCBs which currently do not meet the minimum net worth criteria. So there can be the UCBs that do not have this much of the net worth. So what a glide path has been provided, a path has been provided for them to reach to the minimum net worth that is required. Okay. So UCBs that are not meeting the minimum net worth requirement as above shall achieve the minimum net worth of rupees 2 crore or 5 crore as applicable in a phased manner. So a glide path has been provided, a phased path has been provided. So such UCBs shall achieve at least 50%. So 50% of the applicable minimum net worth on or before 31st March 2026. So 50% of the net worth they have to achieve by on or before March 31st, 2026. And the entire stipulated minimum net worth, that is the 100% of the net worth they have to have before or on March 21, 2028. So that is till here, by 2028 they have to have either 2 crore or they have to have the 5 crore, okay, as applicable. Okay. By 2026 they have to have at least 50% of the 2 crore and 5 crore. So I hope you have understood about the phased path, you have understood about the glided path that has been provided for the smooth transition of the UCBs to achieve the net worth. Okay. So I hope you will remember the net worth and you will remember the the glided path. Okay, that is 2026 and 28. That is easy. So now moving to the next, that is regarding the CRAR, that is the capital. That is the capital to risk weighted asset ratio. See, when we hear about this now, capital to risk weighted asset ratio, so that is easy. That means we are putting the capital here. To calculate the CRAR upon risk weighted assets. So what is this? We will understand this formula so that you have the clarity about the CRAR. But before that, let's understand the percentages. Okay. So for the tier 1 UCBs, they have to maintain a minimum CRAR of 9%. So we have discussed already about this, that the tier 1 UCBs have to maintain 9% of the CRAR, okay, on an ongoing basis, that they should continuously have the 9% of the CRAR. And the tier 2 to 4 UCBs, they have to maintain the CRAR of 12% of the risk weighted assets on an ongoing basis. So that means they have to maintain the CRAR of 12%. So tier 1 UCBs have to maintain the CRAR of 9% and and tier 2 to 4 UCBs have to maintain the CRAR of 12%. So what is the CRAR? So it is eligible total capital. See, what happens that the banks, we are discussing about the banks, right? The urban cooperative banks. So what are their assets? The loans that they are providing, like I'm giving you the loan. So that is my asset because I'm earning something on it. I'm earning interest from you. So those are my assets. So the banks giving the loans are the assets of the bank. Now when I am giving you the loan, there is some risk attached. What if you do not give the loan back? So there is some risk that is attached with this asset, the risk that is attached with these loans. Okay. So, and maybe you are a very trustworthy person. So the weight of the risk is very less, only 2%. Out of 100% of the risk, there is only 2% risk that is there. Now I am giving the money to a corporate, let's say. The risk is 20%. So we have to weight the risk of the asset. That if I'm giving the loan to this person, how much risk is there? I have to weight that. And if I'm giving this person the loan that is very trustworthy, how much risk is there? Okay. So in some assets, in some loans, the risk will be less. In some loans, the risk will be more. So this is total risk weighted assets. So I have given you the loans of like I have given different people. The bank has given different people the loan of 100 or 10 crore, let's say. So that is the total risk weighted asset that is there. Okay. So now eligible total capital from this 10 crore of the loan that I have given, I have to keep against this 10 crore, I have to keep some capital with myself. That what if 1 crore doesn't come back, or what if 50 lakhs doesn't come back, or what if this 10 lakh of the loan that I have given doesn't come back. So let's say the capital is what? It is 12%. So the UCBs have to maintain 12% of this 10 crore, or 10%, or the tier 1 UCBs have to maintain 9% of this total risk weighted asset. Okay, now I hope you have easily understood the CRAR. That is, the banks have to keep some capital with themselves so that against the total risk weighted assets that they are doing. Okay, so this is CRAR. Tier 1 UCBs have to keep 9% of the CRAR. Tier 2 to 4 UCBs have to keep 12% of the CRAR. Okay. So see, currently all the UCBs are keeping 9% of the CRAR that the Reserve Bank of India has said, and this was the criteria that was going on before also. Okay, so that is 9% is already achieved by all the banks. So UCBs now, so for the tier 1 it is easy because all the banks, all the UCBs had to keep 9% with themselves. But the problem comes in front of 2 to 4 tiers because now they have to move from this previous 9% to 12%. So UCBs that are in 2 to 4%, they have to move from the 9% to 12% because all the UCBs were keeping 9% as per the before criteria. But now the criteria is changed for the tier 2 to tier 4 UCBs. They have to maintain 12%. Okay, I'm saying it again and again. 2 to 4 has to maintain 12% of the CRAR, which do not currently meet the revised CRAR. If they do not have 12% of the CRAR, then what they have to do? They have to come to 12% in a phased manner. So such UCBs shall achieve the CRAR of at least 10% by 2024. So they have to move from 9 to 10% by 2024. Then by 10 to 11% by 2025 and 11 to 12% by 2026. So by 2026 they have to achieve the 12% of the CRAR. Very easy. I hope you have understood the CRAR. Okay. Next is revised regulatory framework for urban cooperative banks. There is one more thing in this notification that came out. So this notification was regarding the net worth and capital adequacy ratio, but there was one more thing that was regarding the revaluation reserve. So see, if you understand the formula of revaluation reserves, now you will easily understand that what is revaluation reserve and what RBI has said or regarding the revaluation reserve. So coming to revaluation reserve, that was defined in this notification. The revaluation reserves that are arising out of change in the carrying amount of bank property. That is, see, there is a property of a bank. Let's say this is some asset of the bank. Okay. Usually the assets are the marketable securities of the banks. I have taken all of this from the RBI website, so you can trust it very easily. Okay. So the revaluation reserves the typical example is in this regard is marketable security. So let's say this is some asset of the bank, this is some property of the bank, that is a marketable security. And the value of this marketable security was 1 crore in 2010, let's say. Now, in 2013, it was revaluated. Okay, it was evaluated again, we can say. So now in 2013, we have seen that the value has changed from 1 crore to 5 crore of this marketable security. So revaluation reserves arising out of change, the change that has happened in the carrying value of the bank's property. So the bank's property, the carrying value means the market value that was there before. So consequent upon its revaluation. So when we have revaluated it, when we have valuated it, what has happened that the value has changed. There is change in the carrying value, there is change in the amount of the bank's property. And now the change that is there. So revaluation reserve is market value of the asset at the current period. So the current period is 2013. So the market value is 5 crore of the asset and book value of the asset. What we have calculated in 2010, that is the book value. So it is 1 crore. Or we can say the revaluation reserve is equal to assets market value. So it is 5 crore and assets carrying value means what we have calculated before. So it is 1 crore. So how much is the revaluation reserve? It is 4 crore. This is the change that has happened in the value of the bank's property. Okay. So I hope now you have understood the revaluation reserve. Now what the RBI is saying that the tier 1 capital, now this revaluation reserve will be in tier 1 capital. This revaluation reserve will be in tier 1 capital. This revaluation reserve, this 4 crore will be not 4 crore, but this revaluation reserve will be in tier 1 capital. Now the catch here is discount of 55%, that is minus 55%. Okay, from 100% we are deducting 55%. So the revaluation reserve, 45% of the revaluation reserve will be in tier 1 capital. Discount means you have to deduct that much percentage from the 100%. So that means if the 4 crores are the revaluation reserve, then only 45% of the 4 crores will go to tier 1 capital. I hope you have understood this very clearly. Only 45% of the revaluation reserve can be shown in the tier 1 capital. So this is all what the RBI has said regarding the revaluation reserves. I hope you have got the basic idea. Though this is current affairs, so I am not indulging too much in the revaluation reserve, but I have shown you what is the basic idea of the revaluation reserve, that the property is revaluated, the property is valuated again, and there is some revaluation that has happened, there is some appreciation in the value that has happened, and that appreciation, the change, is the revaluation reserve, and 45% of that change, of that revaluation reserve, is kept in the tier 1 capital. Okay, so I hope you have understood this very clearly. So this is all that is here. But now the following criteria. Now tier 1 capital, it can become tier 1 capital, but it has to meet the criteria also. That is, the bank is able to sell the properties, that the marketable securities that are there, the bank is easily able to sell it. Then only it can come in the tier 1 capital, because tier 1 capital is the liquid capital. Okay. The revaluation reserves are presented or disclosed separately under the reserve fund and other reserves. The revaluations are realistic. Now we are saying that it was 1 crore worth before. Now it is 5 crores of the worth after 3 years or in 3 years. So it should be realistic, that it is actually the market value of that time. Okay. Valuations are obtained from 2 independent valuers, so we have more trust in the value at least once in every 3 years. Okay. Where the value of the property has been substantially impaired or changed by any event, we have to show it, like something COVID has happened. So the value has changed of the property. So we have to value it again when there is some different kind of circumstances that is happening. There should be external auditor of the bank have not expressed a qualified opinion on the revaluation of the property. Okay. The instructions on valuation of properties and other specific requirements, they have been mentioned here, and that has to be strictly adhered to. So I hope you have understood about the revaluation reserve. The revaluation reserve which do not qualify as tier 1 capital shall also not qualify as the tier 2 capital. So 45% of the revaluation reserve that are coming in tier 1 capital. Now this 55% of the revaluation reserve that are not coming in the tier 1 capital, They should also not come under the tier 2 capital. This is what it is saying. Okay. The bank may choose to reckon revaluation reserves in tier 1 capital or tier 2 capital as the bank wants. They can keep it in tier 1 or tier 2 also as per these conditions. Okay, these conditions has to be fulfilled. Two auditors should be there, two different auditors valuing, and it should be disclosed in a very realistic manner and everything. Okay, so this is the first question. I hope that you can easily answer this question. Okay, and this is the second question. And these were the people that gave the right answer to previous session question: Himanshu, Triveni, Nadeem, Uday, Shloki, Yash, Riya, Anand, and Avantika, Nikita. So thank you very much, and thank you for all your congratulations. It means a lot to me. Okay, thank you very much. And do subscribe to our YouTube channel. The PDF you will get in the Telegram channel. Thank you very much, everyone. Thank you a lot.